let's get straight to the market action. Stocks fading through the session today, closing near worst levels. Indices turned lower in midday, as we just mentioned before, after debt ceiling talks concluded without a deal. Joining us now, Barbara Doran, CIO at BD8 Capital Partners, and Craig Fehr, principal and investment strategist at Edward Jones. Good afternoon to you both. Barbara, I'll start with you. The fact that the S&P did end the day down 1%, and oh, by the way, most Treasury yields also turned lower in the second half of the session as well. I mean, what does that tell us about sentiment here?
Well, I think that there's been a lot of skepticism all along, despite, the run-up we've seen in NASDAQ, and that's because the market advance is so narrow with all the big cap tech names. Clearly, the debt ceiling is an overhang. I think most people mentally think, okay, it cannot happen, and so you're not seeing the market really discount it. But there's still that fear, that 0.001% chance that could happen. So I think that's happening there. Plus, we're more than 95% of the way through earnings, and earnings have been overall pretty darn good, 75+% for earnings and revenue beating expectations, but we're winding down this week with some retailers and the semis. And so that catalyst is going to be it's going to be back to focusing on the PCE inflation number on Friday and the Fed when they meet in June. Yeah. And trying to game whether they're going to pause here or raise interest rates more.
Yeah, and of course that PCE reading on Friday is going to be very much in focus. We get Fed minutes as well tomorrow, Craig. And then, of course, I realize it's been somewhat of a mixed bag in general, day to day. But today you had some pretty resilient data, whether it was flash services PMI or new home sales this morning as well. Looking through your notes, base case for you is a mild recession. You sticking with it?
Sticking with it. Morgan, I think you're right, though. If we look at small caps holding in today, that probably corroborates exactly what you just said, which is some of the data that we got today are not signaling, as has been the case for a while now, are not signaling an imminent or even deep recession. Our base case remains that we're probably going to slide into some sort of a mild recession. I'll note it might look quite atypical at this stage. We've already seen cylinders of the economic engine misfire. The consumer continues to hold in. And so at the time we see some more fatigue from consumers, that might be about the time we're seeing a rebound in other areas of the economy. So we not get that big whoosh to the downside. But broadly, we do think that we're at a phase where economic activity is going to decelerate. Markets already moved to price in a lot of that last year. But I do think we're probably setting ourselves up for a bout of volatility and anxiety, just given the markets have been quite lethargic for an extended period of time, today being really the first bit of volatility we've seen in some time.
Yeah. It reminds me of what Torsten Slok from Apollo said on our air yesterday. He's calling for basically a non-recession. Craig, what does that mean in terms of how you're positioned in this market? And if the worst of the fears, or I guess the worst of the impact of this has potentially already come and gone in the market last fall, does that mean you're constructive?
I would say constructive is a reasonable way to put it. Our view is that heading through the summer, there's going to be a bit more chop to this market, largely because this rally that we've seen so far this year, whether we go back to the lows in October and we're up better than 15%, or even look year to date, 8+% on the rally, it's really been predicated on a view that markets expect the Fed to cut rates pretty aggressively. Now, we've taken, 50 basis points of those rate cuts out of the market just in the last couple of weeks, which I think is good news. But I think the markets are still a little bit too complacent. But I'll stick with your other word, which is constructive. I think markets went last year to the negative outcome from Fed tightening. And now this year, I think markets are starting to look ahead to the ultimate economic and earnings recovery late this year into 2024. And I think you can, as an investor, I think you can be optimistic there. We're pulling in the oars a little bit. We're rather neutral on an asset class perspective, really looking for an opportunity to become a bit more constructive, to add to some risk positions as we move into the latter stages of the year.
Okay. Barbara, we could talk about this rotation out of big cap tech today. Do you like big cap tech, given the fact that we have seen such a rally this year, and as we do look to NVIDIA earnings after the bell, and there's been a lot of debate about whether that valuation of that stock specifically has been overstretched?
Yeah, I mean, it's the question of the moment, isn't it? Because we've had such a monster run, and typically you can see a pullback and a rest in any kind of stock or sector that's had such a run. But if you look at Microsoft or Meta or Apple or any of these, number one, interestingly enough, Morgan Stanley did a piece yesterday that they are still underowned versus their weighting in the S&P 500. And if you look at even where their peak PEs are, they've had a big bounce back from the low of late last year, but they're still only halfway back in terms of PE and their valuation into their peak PEs. And obviously we know what's happened. Number one, starting out the year, things were super cheap, a lot of these mega caps. And we've had a big new thing called AI, which has really awakened investors to what is happening here. And of course, they had an early start, whether it was Facebook or Apple or Alphabet, cost cutting employees, this sort of thing, starting in the fall, and they continued into this year. So they're well positioned. And of course, if you think growth is slowing, here are super growers with big cash flow. So I think there's more to come. I think right now a rest would be normal, and so I wouldn't chase it, particularly something like Nvidia, which is going to be a long run winner. But what we know in stocks like this, the earnings will keep coming up, and they will grow into their valuations. So not so worried for even the medium term to long term, but for now, you might not want to chase.